Paul, here in Europe, it seems like the only thing you need to know is that oil prices have been going up all this week, and we're just flirting with $106 a barrel as I look at Brent. And that seems to be what matters to European stocks. Meanwhile, the Nasdaq is focused much more on Intel and that particular story. How are you looking at this particular divergence right now?
Yeah, divergence is the word, I think, Anna. Good morning. So the market is really sort of grappling with these two different things that are going on, right? On the one hand, we have the AI boom still getting priced in or repriced in. And so we're seeing that continuing acceleration of US tech-heavy equities and, for that matter, North Asian stocks as well. But each day this week, each day that this conflict goes on, we're seeing those oil prices steadily increase. And this has been the biggest percent increase since that first week of the war as well. And that tells you that we're really seeing sort of stasis, no signs of a shift in the talks between US and Iran, at least in the public sphere. And the market is starting to get more and more worried about that because we know, and we've been saying it for 8 weeks now, that the longer that this goes on, the tighter the energy supplies get and the more that there's going to be an impact on the economy over time, starting probably in Asia and then spreading west.
Do we resolve the problem of kind of how this market is working? Oil prices up on one hand, but the semi-sector up on the other hand. Does it get resolved by looking at who is buying? It's interesting, the markets team here forwarding me a note that came out of Goldman Sachs talking about the fact that pension funds have actually been selling, but it's the CTAs and to a certain extent re-risking of hedge funds that have been basically chasing this market. Is it that kind of internal flow that tells you about what is happening here? That actually, big picture, institutions are very nervous about this kind of environment, but the CTAs, the momentum chasers, have had to get on board and basically chase this tech story as hard as they have been.
Yeah, and if that's the case, then that sets us up for a rather shaky times, right? Because those are the sort of flightier, faster money investors that are just as likely to get out again as they are to hang on in there. So unless you get a capitulation where you have more of the long-term investors folding into that because of fear of missing out and because of their underperformance relative to the gauge, then at some point the market will potentially run out of momentum, and that could be a dangerous point. Or we get to, a moment where we have a bit of a volatility shock again, some sort of a flare-up, and that turns us around even more critically. What I do think is that some longer-term investors are taking a view as well, because you're seeing that show up, in the relative stability in the bond space and in the currency space, where people are moving back into the carry trade. So because there's lower volatility, people are thinking, all right, target this right, short yen, where interest rates aren't going anywhere particularly fast. Have a look at higher yielding emerging markets, energy producers, places like that where you can put some money and still continue to pick up yield. And that seems to be a safe investment, again, with that proviso that it could all go wrong if we do have another flare up in the Middle East.